Welcome to Thought Leaders, featuring interviews with some of the best minds in the industry. Today's special guest is certified financial planner and registered investment advisor, Rob Odell. Hello everyone, I'm Steve Savant, syndicated financial columnist and talk show host. In this segment, we're talking about charitable planning for clients with immediate gifts, all from Rob's popular Mind Map seminar series. Well, when I think about charitable giving, and especially when we're recording this in December, so this is a big time where America is the number one most giving country in the world by
many
far.
times over. Yeah,
many times
absolutely.
over. And so whatever we're doing, think about this: we're getting taxed by our government, and fair enough. But we're also giving away money, right?
Correct.
And there's so many nonprofits. But I did not realize, Rob, and this is your area of expertise. So you have a great general practice as an RIA, but actually this is your forte.
This is my niche. Yes,
okay,
correct.
so there are games to be played here that I had no idea until I met you and really heard you talk last year.
There's many opportunities that clients have, that advisors need to know about, and how to give. And let's just go through some of the basics here, if you will. But
and before you get started, just keep in mind, we're going to do a whole week show following this series only on charitable giving. That's 5 shows. We're going to break a lot of this out.
Right, we'll get in the deep weeds there on that. Let's just talk about gifts to charity. So most people that I come across are writing checks to their favorite charitable organizations. And if they're giving to a public charity, a church, a university, it's called a 50% deduction. And what that means is if the client makes $100,000 and they write a check for $50,000, they can take all $50,000.
So that's $100,000 on their AGI.
Correct. But on their adjusted gross, the bottom right at 1040. However, if let's say they feel really benevolent and they write a check for $100,000 in that year. Well, because they can only deduct 50%, there's $50,000 they cannot use in that given year, and that's carried forward to future years.
So they could use it, just not that year.
Not that year.
Okay.
They will pay some tax.
Sure.
If they give to a private foundation, which is not as common, it's 30%. Now, thing that really advisors can really distinguish themselves, if they look at a tax return of a client and they see that the client is generous, they're giving 5, 6%, maybe 10% of their adjusted gross income away a year, yet they have dividend income with low cost basis assets, they should always give the low cost basis assets.
Well, give me an example.
I have a client, I saw him earlier this year, and he just became a client. In 2014, he was writing large checks to charity, Habitat for Humanity and others. But he had a lot of low basis stock. And so when I met him, I said, you know what? I met the couple, I said, let's take some of this low basis stock, let's give this instead, because they get the same income tax deduction in terms of dollar amount, but they avoid the capital gain. And that's huge. Now, when you give a low basis asset, a stock, if you will, your 50% deduction goes down to 30% of adjusted gross income, 20% if it goes to a private family foundation. But the key to understand here is they're avoiding capital gains. And these people are high capacity people, meaning the high income people, that is very significant. That's 23.8% they're avoiding, plus they're getting the income tax deduction.
So this is a huge issue for us as planners. We need to look at this issue of capital gain. We should kind of know where our clients are by now and what we're going to do before the end of the year.
Now, one thing I do hear from people is saying, I give the 5 charities, and I have this block of stock, and it's a real pain in the tail to give this away. So we use something called donor advised fund that we're going to go deep in the next week's shows and how to do tax planning and be able to diversify their charitable giving by making one simple gift.
Now, just before we get too far into it, before you get into your trust, these are all tactical issues. Already there's no scrutiny to any of this. This is all IRS approved with this black and white, all part of the code.
Absolutely.
Okay.
Very clean. Finally, last thing, an immediate gift is a little more complex, and we're going to go deep next week in it, is the charitable lead annuity trust. This is a grantor one where you can have someone make a gift to a trust. Maybe they have a spike year of income because they exercise stock options. They had a signing bonus. Professional athletes made a big signing bonus. They can give cash to the trust. They get an income tax deduction they can use in the current year. The income from the trust goes to a foundation or to their favorite charities, and at the end of the term, it goes back to them. Professional athletes, this is popular.
So the actual principal, the original gift, goes back to them, reverts back to the donor.
Correct. But we're doing this for the income tax deduction because there's a spike year of income going on.
And that's a popular tactic. So I give this lump sum to this CLAT, right?
A grantor charitable lead annuity trust.
And I give that to, and then for 5 years, I'm going to be getting income.
You set the terms, but you get the large income tax deduction based on the income that goes to charity.
And then whatever the principal then comes back and reverts back to the donor. Okay, now when you say this, you said you were talking about you identified one high-end athletes.
Well, there's a spike year of income.
Sure.
So if someone had a signing bonus, or they exercised stock options, or they had a...
Well, I'm thinking of a client that just sold his business, and it's a big business. And,
Right.
and I told him, can't you take a payment on December and take another payment in January to kind of help
Yeah.
you out here? But it still's not enough.
Sure.
So he could do something like
You can do
this?
something like this, and in today's interest rate world, when you have low interest rates, charitable lead trusts from economically perspective are very beneficial. We'll talk next week on that.
Okay, now, what I'm looking at, these are just some of the options. Well, next week when we get into full charitable, we're going to get into deep in the weeds not only in this, but we're going to add a few things to it. When you're looking at this from a strictly tax point of view, like I noticed that you quartered off avoiding capital gains. That's why you brought this up
Correct.
about low basis.
Right.
When I'm looking at these things, is there a map in your mind, in your head, where you're looking at these numbers and you're just going, okay, that's over here and that's over there.
Exactly. Well, this is part of the tax planning. And so people, if you have clients or prospective clients who are charitably inclined, and a tax return will show that in a second. Look how much, what is the percentage? What is the relationship between gifts to charity and adjusted gross income? If it's above 5%, you probably have someone charitably inclined, and chances are they're giving cash, and you can come in as an advisor and show them ways in which they can plan their tax return and accomplish their charitable giving goals.
Wow. Well, for more information on end-of-the-year charitable tax planning ideas, just click on the landing page address in the video description. We'll be right back with more from Rob O'Dell.
A solid web presence has never been more important to the success of your business. Introducing Agent Website Creator, provided by CreativeOne. Through Agent Website Creator, you can create your own personalized website and have it up and running easily with zero knowledge of programming. Choose from several designs with easy drag and drop customization. Get proven lead generation offers, professionally written articles, and helpful financial calculators. Plus, the ability to embed videos, integrate your social media, and more. Update your website anytime and show the world within minutes. The best part? It's hosted for free. To learn more about Agent Website Creator, call your CreativeOne sales team at 800-992-2642 or visit us online at creativeone.com.
In this segment, we're talking about charitable planning for clients with deferred gifts, all from Rob's popular Mind Map seminar series. Well, now we talked in the prior segment, we were talking about immediate gifts. I'm writing a check.
Gifts,
but now these are deferred gifts. Now, this is an area where I still am a little fuzzy. Walk me through the mechanics of the basics of deferred gifts.
Well, the very basic is that give an asset to maybe a charitable remainder trust. It does not hit the end charity that actually does something good until you and your wife pass away. That's a deferred gift. But during your lifetime, you get the income. You've given it away.
I've given my principal's gone. I gifted.
And you get an income tax
I'm
deduction.
getting income now.
Right.
But they won't get it until both my wife and I.
It's a deferred gift,
Gotcha.
correct.
Okay. All right.
And so the most simple ones are something called charitable gift annuities. In fact, they're the oldest form of planned giving. In the Middle Ages, people who had lots of real estate would give it to the Catholic Church in exchange for income. That's how the Catholic Church became so powerful back in the Middle Ages. But a charitable gift annuity is very, very simple. It's you give an asset or cash to a charitable organization. It can be as low as $2,500. In exchange, you get a lifetime of income for either you and your spouse or just you.
Any tax advantages there?
There is a tax on that income. There is tax. It's called
the income
exclusion
coming
ratio
back.
income, kind of like an immediate annuity where you'd have interest. If you gave an appreciated asset, there'd be a little bit of capital gain, and there'd be return of principal. So it depends on the asset that you give on the tax nature on that. You receive this income. When you die, it then becomes an asset of the charity. And so charitable gift annuity is very popular for a small donor, someone who just wants to give a $5,000 gift. Universities offer them, medical organizations. But one word of warning is that if you're going to do a charitable gift annuity, you want to make sure the organization you're giving to is going to be around for your lifetime because you become a creditor to that institution. Now, in 1969, a piece of legislation was passed and introduced what's called a Charitable Remainder Trust. It comes out of Section 664 of the Revenue Code. And this is an intermediary trust, or a split interest trust, I might say. So you put property in there, you put cash in there, you receive the income tax deduction. There's a trustee, which can be you, and it'll pay you income based on a percentage that you select at time of inception. This income will go to you, and then upon your death, it will go to the charities that you named in the trust, which, by the way, from a previous segment, could be a donor-advised fund. Why would someone do this? Well, if they have low basis stock, unencumbered land, they can put that in there and avoid a lump sum capital gain tax. Now, as the income comes out to them over their lifetime, that capital gain may come back to them, but spread out kind of like an installment note over their lifetimes there. This is good for older people When I say older people, people probably 65, 70 and above, because the income tax deductions are much more meaningful than someone in their 40s. Last form of a deferred gift, and this actually came in law in 1969, the same time the Charitable Remainder Trust came into it, is a pooled income fund. I should say a total return pooled income fund. Operates a little bit like a charity, but envision it like a charitable mutual fund. Someone gives the property, it goes to the charity, they get the income from it, but upon a second death, it goes to a donor advised fund or actually goes to the charity. Why this is popular, and it's becoming very popular in today's world, is the AFR rate, the midterm rate, 1.2, which it currently is, dictates the deduction. And the lower the rate, the higher the income tax deduction. So for someone, and let's say who's going to do it, is 50 years old, wants to do, looking at a charitable remainder trust versus a pooled income fund, they might consider this because their income tax deduction will probably be triple, maybe quadruple the deduction. Now, the income could be higher. And what the income is based on is what is actually earned by the investments. So if I put money into a pooled income fund and I make 2%, I get 2% paid out to me that year. If I make 10%, 10% is paid out to me. So is there potential for greater income than the unit trust or lesser income? And
you're saying right now the deductions are so high because the AFR rate is so low.
Correct. So for instance, I have a couple, they're 63 and 61. We're looking at a very sizable gift to this. In the charitable remainder trust, it'd be 30%, 32% based on what we're setting up. Here, it's over 70%.
So this matters too. It's not just your charitable intention or your benevolency.
Right.
There's tax issues to be thought about.
Correct.
And how you're going to, what entity you're going to use.
Correct. Now, I would caution, if you lead with tax planning, if tax planning becomes before charitable planning or altruism, it's probably not going to work. You need someone who has a charitable intent, but you're showing them, giving them tools and techniques which can really maximize and integrate their income and estate tax
Now,
planning.
I know we're going to talk about this next week because we're going to spend some serious time on charitable giving. We're going to break a lot of this out.
Yep.
But this pooled income fund issue could be huge. There's some new tweaks, new ideas that you're going to be bringing to us. This could really put you in front of clients that normally you could never get in
We're
front
going
of.
to spend 2 sessions just on this topic alone.
Wow. I mean, that's how powerful
Yeah,
it is.
it is.
Okay. Well, for more information on end-of-the-year charitable tax planning ideas, just click on the landing page address in the video description. And for more information on all our shows, seminars, workshops, just follow us out on social media or visit us out on our webpage. I'm Steve Savant. We'll see you next time on Thought Leaders. And remember, keep thinking outside the box.